What's up guys, Josh Olfert back with another video today, and I want to talk about the worst, the most atrocious, the most horrible stock crashes, single company corrections of all time. What can we learn from them? Time to think like an investor. So as the narrative goes these days, even I posted a video a couple days ago talking about how stocks go up. And we have people like David Portnoy from Barstool, who's become a famous day trader. He goes by Davey Day Trader now. He talks about how stocks only go up. And you see Wall Street Bets and on Reddit and all these places, people are talking about how stocks only go up. Now, this is where I draw a point of contention because that's kind of true. I mean, stocks in aggregate. I mean, if we're not talking about one stock, we're talking about the market in total. Yes, in developed economies, United States, Canada, places like this, the market tends to go up as a whole. But when we're talking about specific companies, like one-off companies, not every stock always goes up. That is a complete fallacy. That's not true. And in fact, there was a study done at I believe it was at Arizona State University by Hendrik Bessembinder. And he did a study that talked about, do stocks outperform T-bills? And T-bills, if you don't know, are just like a very short-term savings account, like a short-term bond, a very low-paying bond investment it's barely any gain whatsoever. And what he found in the study is that most stocks in the market, most of them do not actually beat a short-term savings account like a treasury bill. They don't, which is crazy to think because we know and we always hear this thing over time, stocks always go up and you should invest in the stock market because it always continues higher. It's a great investment. But the reality of the situation that Bessembinder found in his study is that if we look at the total lifetime wealth created in the stock market, I think the period was 1926 to 2016, something like that. He found that of all the wealth created in the stock market, almost all of it comes from the top 4% of publicly traded companies. That is crazy. And what this means in statistics, if I want to get technical, it means that the stock market or stocks have a positive skew. They have positive skewness is what a statistician would say. And what that means is most stocks are frequent losers. Most stocks are, the stock market is a place where we have a lot of frequent losers. A lot of companies lose very frequently, and occasionally we have a few subset of stocks that do extraordinarily well that kind of put their team on their back. They kind of carry the stock market. Another thing to understand is that in some countries, depending on the demographics and the economy, I won't get too boring here, but a country like Japan, for instance, their stock market is in the same place today after rallying and doing quite well this year. They're in the same place today that they were 30 years ago. So somebody who invested in the stock market of Japan is in the same spot they were 30 years ago. 30 years and no growth. So this idea that stocks only go up is pernicious and it's dangerous. So what can we learn from the worst subset of companies, the companies that actually perform the worst? So today I want to go through what were the worst stocks you could have possibly owned and how catastrophic was it to own them. So where else could we begin other than this last recent Great Recession in 2008? If you don't necessarily know what happened there, I suggest you put some time into going and learning what happened in 08 because everything that's happening, or a lot of things that are happening in the market today, are based on the events that transpired in 2008. And big companies like Lehman Brothers, which was a massive investment bank, very well respected, big Wall Street company, companies like Bear Stearns, AIG, these massive financial services companies found themselves in the absolute tubes after the financial crisis. And what happens, if I could explain it, is think about a situation where a lot of people are taking a ton of risk and they can just shovel it off to someone else so that person holds the risk. And then they can shovel it off to someone else so that it's like a game of hot potato, honestly. You don't want to be the last one holding the potato. And in the real economy, what this was really bad loans. They had these things called ninja loans, no income, no job, no assets. And they would lend people who didn't have a job, $1 million to buy a house. And you might think, why would they do that? It's because they were taking people's mortgages and packaging them up and reselling them off to other people. So they didn't really care about the risk of the borrower. And what happens is these financial assets, which were called mortgage-backed securities, they were trash and they made their way around the entire financial system And Lehman Brothers was one of the big banks, as well as Bear Stearns, who was holding the hot potato when this happened. In late 2008, because they were left holding the bag, Lehman Brothers dropped from a price of $80 a share to $0 a share within a few weeks. They actually went completely bankrupt. And the funniest thing was on CNBC, Jim Cramer, what do you think of Bear Stearns? Should I get out of Bear Stearns as an investment? And this is what he said.
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Now, next up, we cannot do this video without mentioning Enron. Now, Enron was one of the largest energy companies in the United States. And, you know, they had a very interesting management style. It was a very vicious management style. And this company was all about getting their stock price to go up so they could get fantastically wealthy. And one of the things they did was they used something called mark-to-market accounting. And what that means is they would buy some massive production facility or plant, and they would go, okay, well, this isn't just worth what the plant is worth today, it's technically also worth all of its future revenue and income that it can produce. So maybe we'll just put that on the books as if it's worth all of its future production value. Like, for an example, you could say, okay, you know, my name's Bob, I make $100,000 a year, and I'm gonna do that for the next 50 years, so I'm technically worth $5 million. It's like, that's not true at all. You can't just extrapolate out future earnings and say that's what you're worth today. So essentially, over time, the company Enron had some very dubious accounting tactics. They started to record things that weren't necessarily true on the books. Over time, people started to realize that this was actually a huge fraud. And what happened was from late 2000 to 2001, the price of Enron stock dropped from $90 down to $0. 100% loss in a very short period of time. And the funny thing is, you know, the management team went to jail for their fraud. Jeff Skilling was the guy who was kind of behind this whole thing. And in 2019, he actually got out of jail and he went to the press and said, I'm looking to get back into the energy business because I thought of a really great, unique idea in jail. So if you guys have startup capital for Jeff Skilling, hit us in the comments below. Would you invest in someone who is an ex-con? Let us know. Now, the next company we have to look at, which was an international catastrophe, was Worldcom. Now, Worldcom was a business that was in the utility of, you know, phone lines and doing networks amongst, phones, I guess. It was a telecom, that's the word I'm looking for. Telecommunications company. And the best way I could describe what happened to Worldcom is that the CEO and the management team of a company are hiring for a new accountant, CFO, controller, somebody manage the finances. And the CEO asks the potential, the first candidate in the interview, what's assets minus liabilities? And, you know, the accountant says, well, it's equity. That's the accounting equation. Great, thank you so much. We'll call you back in 2 weeks. And, you know, applicant number 2 comes in and the CEO and the management team interviews them and says, okay, so what's assets minus liabilities? And candidate number 2 says, that's owner's equity. That's the accounting equation, not that hard. And they said, okay, great, we'll call you in 2 weeks. And the third candidate comes in and the CEO and the management team say, okay, sir, so, you know, what is assets minus liabilities? And the candidate says, what would you like it to be? And the CEO and the management team says, you're hired. And this is exactly what happened to Worldcom, if I think of it in a very simplistic way. Same kind of story. The company, you know, here's something interesting about publicly traded businesses is they have a vested interest and the management has a vested interest in keeping the stock price high because a lot of times they're paid in stock and they own a lot of stock themselves. So if the company starts doing poorly or if financial results aren't coming out as per their expectations, they know this could hurt the stock and they start to manipulate the books. They start to manipulate the balance sheet, the income statement, manipulate their accounting to make it look like they're doing better than they are. So once the market and investors started to realize that the accounting was fraudulent and all the earnings they were posting weren't actually true, the price of Worldcom dropped from $16 a share down to $0 a share, one of the biggest companies in the world at that point, and they failed completely. An investor in that company would have lost all of their money. Next up, one that's close to home for me is a company called Nortel. And in Canada and North America, this is an infamous story about a telecommunications company, quite like Worldcom, who just got ahead of themselves a little bit. And Nortel was doing a lot of things right. They had come up with this innovative technology for how they were going to revolutionize the way that telecommunications worked, because it was the dawn of the internet era and they had all these fantastic ideas. But what ended up happening is that Nortel was innovating at a time where there was a ton of innovation, and they kind of ended up behind the 8 ball a little bit. Now, Nortel up to this point, because of their success thus far, actually became a third of the Toronto Stock Exchange. The Canadian Stock Index, a third of it was Nortel. That's how influential and how massive this company became. But just like the other companies we've looked at, when Nortel was making these acquisitions, they were reporting it on their books in a way that wasn't necessarily completely, let's just say it was a bit of a gray area in the way that they were acquiring these companies and putting them on their books. Over time, Nortel started to come up short over and over again. And when analysts were estimating their revenue was going to be X and they were going to have positive numbers, Nortel actually came in with a negative earnings figure for the first time, signaling to the market that this company with massive expectations was actually now going to be losing money. And in the early 2000s, Nortel fell from over $800 per share and being one of the largest companies in the world. I believe it was one of the top 10 biggest companies in the world, and it fell to zero. And when you're a company that big, there's retirees holding your stock in their pension plans. There's all of the employees of Nortel who had their stock in Nortel and their pensions with Nortel. All of that money vanishes. And lastly, one company that's a little more recent, and I'm gonna take a bit of a shot at here, is Nikola. And you may have heard of this guy, Nikola Tesla. He was a scientist, and there's a car company, Tesla, named after him because they're an electric car company. And Nikola is also named after Nikola Tesla. It's kind of like a cheap ripoff of Tesla, but this company came out saying they were going to revolutionize the way that fuel cells worked, and they were going to come out with this vehicle that was going to compete with Tesla. And they did a really good job of it. The CEO and the management team did a fantastic job of selling the hype. They were selling the hype of this new technology. But then, all of a sudden, this research firm, this forensic investment research firm called Hindenburg, comes out and essentially goes public saying Nikola is a complete fraud. Where do we go from here? I mean, it turns out that the truck they had used in prototype videos wasn't actually running. They had just pushed it down a hill and filmed it. There was no truck that actually worked. The chief of their research and development, who was supposed to be brilliant and had all these great ideas, they actually found out that his only job qualifications is that he was pouring driveways. He was pouring concrete in Hawaii. That was his certifications. And other management staff at the company had been kicked out of NASA for spending NASA budget dollars on prostitutes, all sorts of crazy stuff. And Nikola didn't deny the allegations. They came out and, refuted a few of them, but for the most part accepted a lot of them as true. And this year, in 2020, Nikola dropped from $80 to $20 after having so much hype and after having all of these people really believe this was going to be the next Tesla. So what can we learn from all of these different companies? Well, like I said at the beginning, it's important to understand that yes, the market in aggregate goes up, but it's a very small portion of the companies that really put the team on their back. A lot of different businesses, like these ones we've looked at, AIG, Lehman, Bear Stearns, Worldcom, Nortel, these looked like fantastic companies in the moment, and tons of people owned them, thinking nothing of it. But when you're picking stocks, and if you want to be someone who's picking your own stocks in the long run, what this means, if we look at what do all these companies have in common, it comes down to their accounting and hiding things to keep their share price up, right? So if you want to become a stock picker, it is so pivotal that you understand how accounting works. And this is what, CFAs, financial analysts do. They dig into the books of a company and find out, is there something we're not seeing here? Because in the worst case scenarios, it's that something is being hidden in the financial statements. And lastly, if you want to be someone who's picking your own stocks, not just as a hobby or for fun, but with the majority of your own money and running your own portfolio, it's super important to understand that not only do you have to pick the right stock. You have to be in the right 4% of stocks to have success over the long haul. And this is why strategies like passive index investing, where you own the whole market, have become extremely popular. Because for a very low price, you can almost guarantee that you are getting in with that 4% that's actually gonna move the market forward. So anyways, guys, thank you so much for watching this video. I hope this enlightened you on the past about how stocks don't necessarily always go up, and individual stocks tend to actually not go up, at least more than a treasury bill. So if you guys learned something, if you guys enjoy these videos, please hit that like button, hit subscribe, and turn on post notifications for more videos just like this one every single week. Until next time.